Federal Reserve just concluded their September meeting, gave their press release, and Powell is increasingly sounding like the new Volcker. In fact, he said in the statement, he said, "We will keep at it until the job is done," giving an echo back to Volcker, keeping at it, echoing the title of Paul Volcker's biography, Keeping at It, and Volcker's legacy of crushing inflation in the 70s by continuously raising rates until the job was done. Ready? Let's dive in. Before we get into the actual release, let's take a look at what the market is doing in response. So number one, the dollar is up today, up to 111. Just to give you some perspective on how high the dollar is, the dollar has not been this high since 2002, 20 years here, over 20 years, and it was barely above this level for any length of time here. Usually it's way lower. Now, it's the same exact thing when we look at rates. So like the 2-year rate is up above 4% now, hasn't been this high since 05, 06, 07. So it's clearly broken its long-term trend of moving down here. We're seeing the exact same thing with the 10-year being at multi-decade highs. We're seeing the same thing with the 20-year being way above trend and the 30-year as well. Earlier in the day, markets were up on the news that it was a 75 basis point hike instead of something worse like a full percent, but now markets have started to fall off towards the end of the trading day. Still, assets like silver are up about 2.5% as of the time of this recording. Gold up about 0.75%, still below that key support and resistance level of 1680. So markets moved this way basically in response to the anticipated move of raising rates by 0.75%, 75 basis points, and the Federal Reserve signaling continuing to tighten until the job is done. They mentioned that, Powell mentioned that in the press release quite a few times. So they raised the Fed funds rate to the range of 3 to 3.25%, anticipating that ongoing increases will be appropriate. They'll continue to reduce the size of their balance sheet, which is composed of treasuries and mortgage-backed securities. And we have some notes here about their monetary policy implementation, and these notes are where things get a little bit more interesting. They're going to conduct overnight repurchase agreements, so that is in the repo market, with a minimum bid of 3.25% and a limit of $500 billion. Now, this doesn't yet come into play. There's not a lot of activity by the Federal Reserve in the repo market because most of their activity is on the other side of that in the reverse repo facility, which is the next one here. They're conducting reverse repo repurchase agreement operations at an offering rate of 3.05%. Why 3.05%? They keep with 0.05% above the bottom of the range for the Fed funds rate. And this is what they've been doing the entire time. They had initially, this was at 0. There was no use. Nobody was using the reverse repo facility. And then they bumped it up to 0.05%, started sucking some cash in. Then when the bank collateral requirement suspension ended so that the banks would have to follow those capital requirement rules again, then a bunch of money started flooding into the reverse repo facility to get all that collateral. And they've kept this rate at 0.05% above the Fed funds rate. And this means that all of the banks, all the financial institutions using the reverse repo facility are getting risk-free money. And now it's up to 3.05%. Right now, there's approximately $2.3 trillion that will be getting a little bit of a pay raise here, up to 3.05%. And I've mentioned this many, many times before, but at a moment's notice, the Federal Reserve can decide to drop that rate that they're paying into the reverse repo facility, and all that money that's in there that's getting a risk-free return on their money, better than T-bills, better than treasuries, better than anything out there on the market, all that money will flood out because they won't be getting paid enough, and then it'll be worth the risk to go buy things like bills. So at the moment when liquidity dries up and there's some sort of an emergency, this will be the first sign of something breaking in the bond market, the credit markets, the treasury markets, is when this reverse repo facility drops the award rate that the Fed is paying on it and pushes all that money back out into other markets. Now, there are a couple good questions with some good answers here that indicate where the Fed is trying to go especially Powell here. The first question was relating to the lag between monetary policy and the results of that monetary policy. Now, Powell has admitted this before, but he admitted it again today that there is a huge lag between when monetary policy is enacted and then the results of that. So, but he distinguished, which is correct, that financial conditions respond before the monetary policy actually happens. So they give hints and leaks and little statements on the news and things like that. And then the financial system responds to their expectations about what the Federal Reserve is going to do before the Fed actually even does that. And so that is true. So interest rates move, asset prices move, all of that in anticipation of what monetary policy will actually be. And then there's a huge lag between that and then when those tighter conditions or easier conditions, whatever they're doing, actually hits the overall economy. And he recognized this and he admitted this and said, yes, there is a big lag between what we do and when it hits the economy. But despite the fact that he admitted that that happens, didn't give any sort of indication that they might be tightening right now into some, financial conditions or economic conditions that are already naturally getting tighter, building up a storm from both sides of the equation. Apparently no realization that they might be contributing too much deflationary forces since they're contributing, and then that's also what is naturally building up in the economy right now. He mentioned multiple times in multiple answers to people's questions that the goal is to make policy restrictive. And so especially compared to the jobs market, he wants to see job openings come down. Job openings, in his opinion, are way too high compared to the number of unemployed people. And so restrictive policy means seeing those jobs numbers, those job openings especially, come down. Now, I thought there was a great question about real rates versus nominal rates. And his answer was that, this is surprising, that he actually thinks that they should see positive real rates across the entire yield curve. He said basically that's the ideal goal. We would like to get to a place where whatever rate you're looking at, whether it's the 2-year, the 10-year, the 30-year, all of those interest rates are higher than the inflation rate so that there are real positive rates across the curve. Now, we haven't had real positive rates in a long time. Even though rates have been going up, inflation has been higher, meaning that real rates have been negative. And so he came right out and said, our goal is to get to the point where these rates are positive on a real basis, not just nominally. That's huge. And I think that's very important. And that's a healthy place for an economy to be, regardless of what that does to asset prices, regardless of what that does to economic conditions short term. That's a very healthy place to be where interest rates are actually positive. That way, you're not destroying wealth by investing in something with a yield below inflation. So in summary, the main takeaways from this are that number one, they're going to continue to raise rates here. Number two, until they see that monetary policy is restrictive, job openings start coming down. They're not paying attention to the stock market. They're not paying attention to how much pain this might cause people. Their job right now is to get inflation down. Using phrases like keeping at it until the job is done, they're intentionally echoing Volcker, who, again, like I said earlier, is famous for getting control of inflation by continuing to raise rates despite how painful it was for the economy at that time until they got inflation under control. And for everybody out there who says that you can't meaningfully control inflation or bring inflation down without positive real rates, even though that's wrong, and I've made videos about that before, I can keep on making more videos about that in the future if necessary. Even though that's wrong, people still think that we need positive real rates to combat inflation. That's where they're going. So for everybody out there that wants that, that's the goal. Powell came out specifically and said, we are trying to get rates across the curve positive on a real basis so that they're higher than the inflation rate. Whether that means the inflation rate is 2%, yields are at 3%, whether that means inflation is at 5%, so interest rates have to get up to 8%, whatever that means, the goal is to get to positive real interest rates. So despite the fact that this will bring some economic pain for many people, long term, this is a very good sign. And if they stick with it, it will be very healthy for the economy in the long term. Here's to hoping. As always, really appreciate you guys. Thank you so much for watching. Have a great day.